Hi, everybody. I'm really excited for our guest today. He's actually a friend of mine, and we've met each other several years back. We contribute to different macro investment communities and speak at different events, but we've recently become friends on the paddle court, and I thought this would be a really good opportunity to bring one of the most well-known macro investors and publisher of a newsletter in the world to talk to you and give him his insights on what's happening in the world of investing. I hope you find this interview interesting, informational, educational. And again, like all of our videos, this is supported by America Mortgages. We're a U.S. direct lender focused on lending to foreign nationals and U.S. expats living outside the U.S. We've got loan officers all over the world, and we're the only bank that has this type of exposure. Secondly, Global Mortgage Group. And all this information is in the bio or description below. We are an international home equity financing company. If you're looking to pull cash out of your home equity in Singapore, US, London, or Australia, we're your company and we can help you with that liquidity solution. So I look forward to hearing from you. Thank you. Hello, everybody. Thank you for joining us today for our first monthly discussion with a renowned macro investor, Geo Chen, who is the author of a well-received, popular macro newsletter, Fidenza Macro. We're going to discuss 5 hours worth of topics, and we're trying to condense it into 30 minutes, 40 minutes, and open it up for Q&A. It's a really timely discussion given all of the, all of the news out at the moment with regards to tariffs and rates and things like that. And so I'm really excited to pick Geo's brain on what his views are of the current macro landscape. And I'll let Geo talk about his newsletter, but what I like about it, I'm a subscriber, is that he puts his money where his mouth is. He'll talk about the trades that he's actually putting on himself for the fund that he manages. So, in this next 30 minutes, we'll talk about equities, bonds, currency, rates, inflation outlook, geopolitics, gold, Bitcoin, and I'll try to wrap this all up within the context of what we think about the U.S. real estate market. So without further ado, here, Geo Chen, how are you doing?
I'm good.
Yeah, good to have you on the show, and I look forward to having you on towards the end of every month till you get bored of us. So listen, we're going to try to condense a lot of information in a short period of time. So I'm going to just break these down into little bits and pieces. So equities, what are you thinking?
Yeah, I mean, it depends on which equity markets we're talking about. If we're talking about the S&P, they're definitely expensive up here. But the entire market, whether you're talking about retail, systematics, hedge funds, they're not really that long as they could be. So I could see a situation where the S&P just keeps grinding a little bit higher and higher. And then maybe at some point later this year, we see another dip. And that dip, in my opinion, will be the one to buy. So I'm not really, looking to be long or to buy here, but I'm kind of waiting for, Trump to do something to create more volatility at some point this year. And that'll be the dip to buy. I think international equities are really interesting, and that's where a lot of outperformance could be in. There's a lot of rotation out of U.S. equities and into international equities, and that includes EM, LATAM, Asia, and I think it's a story that could, have legs for a few years at least, because international equities have underperformed U.S. for such a long time. So there's just so much underperformance that could be unwound.
There are two things from a personal view. When Trump kind of backed off the tariff sound bites, I figured that was kind of this tariff war could be on a pause, and that was a bullish signal. But in terms of equity, I read this something from Bridgewater saying that 70% or 80% of all equity investments globally were U.S. related. So there's just such an over allocation to the U.S. that it doesn't take much to move some of that offshore outside the U.S. to drive international equities. Okay, so let's moving on. So quick, bonds. So short end, long end. What are you thinking? This is the $1 billion question here.
Yeah, yeah. I mean, bonds have been really interesting this year. And what's going on in the long end of the curve is where all the action is at. Because the long end of the US Treasury curve, the long end of the JGB, the Japanese government bond curve, also UK gilts, they've all been selling off. And I think this is a new paradigm where asset managers, we're talking about reserve managers, pension funds, they're not comfortable buying long end treasuries, 20, 30 years in duration anymore, because suddenly they're realizing that their capital is not quite safe in these long duration assets. They could be, sanctioned, technical default. They could be taxed. The capital could be inflated away, and they could just experience, just capital drawdowns in those assets. So now they require much larger, compensation to hold those bonds. So that's why yields are going up. And where the bottom in bonds could be, I mean, it really depends on what these institutions think is an appropriate return for locking up their capital for 20 to 30 years.
Yeah, if I'm sitting outside the US and I have some cash, whether that's retail or institutional, and I'm thinking, where am I going to put it? So obviously, equities in the US is still pretty strong. The long end is precarious. So a lot of that money could be going into gold, which I'll ask you about later. Well, how do you reconcile, since we're talking about bonds, I want to move on to the JGBs and why that's important, because I think the audience needs to know that's actually a big wild card. And I don't think the public understands how is Japan related to the rest of the world and how is it going to affect us? So how do you reconcile the fact that I personally think that the long end will continue to rise? How do you reconcile the debt rollover with the long end? Like, what do you think policymakers are thinking?
Yeah, I think the amount of debt that needs to be issued and rolled over every year, and this is the same for the US and Japan, just keeps increasing every year. This is because of budget deficits, because of rising interest rate costs. So it's just spiraling out of control, and they've reached the limit of how many buyers are going to be there at any given yield to buy it. So that's pretty much what's going on. It's a supply and a demand story that's being hurt by negative sentiment in the bond market. And there's no easy way out of this. Like, the US can't just flip a switch and set its budget deficit back to zero. That requires a lot of political pain. The Fed or the BOJ can't just do QE and support the bond market by buying bonds, because that's going to make inflation take off again. So it's really a dilemma for policymakers.
Yeah. Okay, so JGBs, these are Japan bonds. Why is that important for the rest of the world?
Yeah. So JGBs are kind of like, well, let's start from why Japanese institutions are very important to global bond markets. Japan is the largest holder of treasuries, US treasuries, and also the largest purchaser of global bonds, across all developed markets. And the buyers are really, the national and private pension funds, institutions, insurance companies, banks. And, so as you know, the BOJ has been doing QE for a very, very long time, like, decades. And they stopped last year. Well, they're tapering. They haven't stopped. but they're winding down their monthly purchases of JGBs. So, you know, JGBs is basically the risk-free rate for Japan, what these institutions can get if they just park their capital at, locally in yen terms in their own bond market. And for a really long time, it was almost zero. Like JGBs were yielding zero because the BOJ was doing QE, and they were really just manipulating or distorting the price of bonds for a very long time. So now the price of the yield on these bonds is soaring to the high 2%, and suddenly these institutions can now get a pretty respectable yield compared to inflation in Japan. So suddenly, why the question they're going to start asking is, why should they be buying treasuries on a hedged basis, for example, instead of JGBs? Because if you buy treasuries, let's say at 4.6, you still have to pay away about like 4.3% just to hedge it. So really, the yield that you get is the difference between 4.6 and 4.3, and it's very little. They should just instead park their money in JGBs, which gets you the high 2%. So that's kind of the calculation here. It's becoming a lot more attractive for Japanese institutions to bring that money back home, sell their treasuries, unwind those hedges, and to put them back into JGBs. So I think that's going to be a potential trend that could play out over the next few years, as that's definitely a downside risk for the U.S. bond market if Japan starts to repatriate their holdings from foreign bond markets back to local.
So I didn't know the swap costs were so high, so I've learned something new. So just for the audience out there, what Geo is saying is that local institutions in Japan can buy their own bonds at 2%, but they were previously, when interest rates were zero, they were borrowing at very low cost and buying U.S. bonds. But now at 2%, the cost in which they need to hedge the currency from Japan dollar to U.S. dollar is actually higher than actually just buying the bonds. So that's kind of interesting. So I can see how they're like, why do I need to go through all that trouble when I can just buy my domestic bonds? Yeah, interesting. Yeah. Okay, moving along. Fed funds, the short end, very short end. Folks out there who think that Powell will cut rates, I think maybe disappointed. I was looking at on the way here, I was looking at the Fed fund futures, and it's below 50% all the way out to October. October's around 50%. So what's your take on this?
Yeah, I think they're not in a hurry to cut, and every meeting, they kind of come to the same conclusion, which is that inflation is still a little bit too high for comfort, and there's no imminent recession that's threatening them. So yes, I think the economy will weaken gradually over the course of this year, but it's not really going to be enough to to get them to cut very aggressively. So I wouldn't be surprised if we finish this year with really only 1 or 0 25 basis point cuts. The front end of the curve, those Fed fund futures out to like January 25, they just keep drifting lower and lower. Basically, those cuts that were priced into the market just keep getting taken out because there's just no urgency.
I'm looking forward to the incremental Trump anecdotes of Powell, like getting angry at him for not cutting rates sooner. Yeah. But the Fed doesn't like to surprise the market, and the market is not really expecting an obvious rate cut cycle at the moment. All right, so we're kind of getting to the halfway mark of everything we wanted to speak about. I guess we've covered equities, bonds, FX. So dollar's been weak. We've, in my very amateurish newsletter that we send out to our clients, I early on, I said that they needed the dollar to weaken. I actually wrote DXY 90 by June. So for some reason, it's come alive, right? It's become true. But what's your view on the dollar? Like more downside, it happened too fast. Generally, your outlook on the dollar.
Yeah. So I think we're at the start of a multi-year dollar bear market, and the reason is, so some of the things I highlighted earlier, which is that equities are too expensive, bonds are unattractive in the U.S. So there's this push factor out of U.S. assets into international assets, and also add to the fact that U.S. policy is just more volatile and uncertain than ever before. So your safety of capital, whether you can bring it back, whether there are going to be strings attached to that capital, um, you know this is really the first time that it's ever been questioned. So so that's one reason, but also there's going to be a pull factor um, from other countries which have more fiscal space. So they have more fiscal space, and they're using it to stimulate their economies. So the first one is Europe, which has a lot of fiscal space. Germany has traditionally been very stingy with their borrowing. Their debt to GDP ratio is very low compared to a lot of developed markets, and they've decided to start turning on the fiscal taps. China as well has more fiscal space, and they also have the political space really to stimulate their economy, um, and plan for the long run. So you're going to have these tailwinds in other parts of the world, whereas there are headwinds in the U.S.
That's well put. Well put. In fact, some of these German defense-related stocks that were trading at low single digits. I mean, these stocks have all like doubled in a very short period of time. So it's a finally, value investors can actually have some price discovery and make some money around the world. All right. Okay. So next is gold, something I'm super passionate about. So what's your views on gold?
Yeah. So I'm pretty bullish gold. I think we're in a multi-year bull market, and this kind of goes along with my dollar bear market view as well, because whenever you have a dollar bear market, gold tends to do really, really well. This happened in the 1970s when the dollar depreciated a lot, and gold went up by 8x from the low over the course of that decade. This happened during the 2002 to 2011 period, which was kind of the first half of my career, and that was another dollar bear market, and gold went up by 6 times from from the start to the high of that period. And arguably what's happening now is even more extreme than what the US went through those previous periods. Right now we're seeing kind of like the crumbling of the American hegemony, potential loss of global like political and economic leadership over the course of the next decade, potentially to China. So I really think that gold could appreciate by multiples over the next few years.
Totally agree. Gold's been in many portfolios. Maybe it's low single digits, 5%, whatever it is. It's always been inflation hedge, store of value. But I think, and let me get your reaction to this. I feel that sooner than we think, there will be some version of the gold standard back. I think it's hard to appreciate when people say we don't want a strong dollar, because there's some sort of geopolitical issues and there's some nationalistic aspects to it. But actually, a strong dollar doesn't do anyone any good. But there are no other alternatives as a reserve currency. Um, I don't want to get too technical, but it does seem like the Triffin's dilemma is coming to an end and it's becoming an issue. I personally think that we may see kind of a two-system currency, global currency, where it's some sort of gold-backed China currency that allows them to trade with partners using that versus the dollar, and then the U.S. still continues using dollar for other things. So, and that's from the anecdotes I see, and I'm sort of an anecdote guy because I don't have the resources to go too deep. But when governments are accumulating gold, you feel like there's something happening behind the scenes, that could, make gold go up a lot higher. And I personally think gold, Bitcoin, and U.S. real estate are probably the three best, investments you can make. And I'll go through the last one a little bit later. Okay, so we're bullish gold. Bitcoin, what's your take?
Yeah, so Bitcoin is interesting because right now it's back at all-time highs. There's definitely still a link to U.S. equities. So when U.S. equities are doing well, Bitcoin also does well. A little bit of a link to gold as well. So it's a little bit of a cross. I think what's going to be really interesting is what happens in the next equity sell-off. Does Bitcoin also sell off, or does it hold its ground and keep appreciating? So that's going to be the real test. What's going on in the market is really a transfer of capital from retail holders, like the whales who have been holding Bitcoin for over a decade. They're up billions on it, and they're starting to sell to institutions and corporates. Corporates like MicroStrategy, MetaPlanet. So there's been a wave of corporations buying Bitcoin for the treasuries, and of course, you have institutions like state and local pension funds also buying Bitcoin. So I think that typically in the past, when you've seen this transition from retail to institutions, volatility definitely goes down in the long run. So I think that we're just not going to see the eye-popping returns that we've gotten from Bitcoin going forward. I think it will still appreciate, but it's not going to like a million anytime soon. It's going to be slower and steadier.
Only doubles every year, so
Modest. I'll live with that. That would be a good outcome.
Yeah, well, it's almost my view is when I first got into it a long time ago, and then I went down the Michael Saylor rabbit hole in 2019, and I was like, wow, this really makes sense. We've been in a world of debasement for all these years, and this is one way to kind of take money off grid, and it's undiluted. So there is no currency in the history of civilization that is undiluted, undilutable. Even gold, I think that supply doubles every 50, 60 years. So I think it just ticks a lot of boxes, of a world that's moving more digital, not less digital. It's a digital form of store of value. I don't know what the end game is, but it's been a painful but rewarding ride. All right. Okay. So we've gotten through equities, bonds, gold, FX. So inflation, what's your view?
Yeah, I mean, inflation, I think, is going to stay sticky. I think the days of like sub 2 CPI are gone. And the reason is that governments just have to keep stimulating fiscally. The U.S., the House is passing a budget bill that's going to keep budget deficit at around 6.2, 6.3% of GDP. The Fed is slowing down their QT. At some point, they may be forced to support the bond market, which is going to increase monetary inflation. So there are, and there's just no political will to really you know to spend less, because what we have in the U.S. is basically a war between rival ideologies, and you know in any war, what happens is that both sides need to spend a lot of money, and they expend a lot of capital and resources to fight the other side. So even though this is not a hot war, but it's akin to a hot war where you had a lot of inflation, a lot of and the price of gold went up, but this is the new you know um, modern warfare, where you have kind of like a civil war of ideas and factions kind of battling out. So I think in this kind of scenario, you're going to have pretty high nominal GDP. Real GDP will fluctuate, but nominal GDP will continue to stay pretty hot.
Yeah, I think the extent at which the tariffs will be felt, nobody knows, because Christmas shipments aren't here. We haven't run out of things yet. There was so much uncertainty. I've heard of people taking ordering things and can't pay the tariffs, and like, I'm just leaving them on the container ship. Or I've even heard of people like knocking some containers off the ships because they didn't want to receive them. But I think when the when there's lack of substitutes in the market and you're forced to pay a higher price, even if it's, I mean, in Singapore, you know, coffee or kopi or kopi kosong, or those the local coffee, you know, coffees that you can drink go from 150 to 175. I mean, people feel that stuff, right? So I think we just haven't seen or heard the anecdotes yet. So it's up in the air at the
Yeah.
moment. Okay, cool. All right. So let's talk about what's on the news the last few days. U.S. universities, and the visas and stuff. Do you have a view on that?
Yeah, I mean, Trump is really just on a warpath, right? And Harvard is his, enemy number one. It's like it kind of like the bastion. Well, from his perspective, it's kind of like the bastion of liberalism, and he just wants to smash it into the ground. Um, and it also represents his war on immigration as well, and painting all foreign students, and basically any foreign intellectual in the U.S. as an enemy, potential spy. Um, so this kind of like reeks of McCarthyism, back in the Cold War days, and I guess we kind of are in a Cold War, um, you know, between the U.S. and China, and the U.S. with itself. So it's really a multi-front battle, and I guess Harvard is just one, one victim in this. But I mean, Harvard's been around for centuries. I think they're going to get through this. Um, Trump won't be around forever, so I think this is just look big picture. I think this will also pass.
Yeah.
Um, maybe what the U.S. won't be able to recover from is the loss of standing amongst the international community. When, for example, like somebody from, um, an excellent student from Singapore might think twice about applying to Harvard now, or any U.S. university, because suddenly becomes a lot more complicated. They have to wonder if their social media is going to get looked at, whether they can get a visa, um, whether they, uh, you know, 2 years, like halfway through their education, suddenly they're not able to travel to the U.S. anymore, right? There's a lot of risk now.
Yeah. I mean, I think, the US, part of the US exceptionalism is the fact that, the US is, I would argue, the only higher level education system in the world that gives you a wide lens. Like, and however you want to define that, and has a lot of schools and a lot of name brand schools. But the logistics is real. Like this morning, I ran into a friend at the American Club, and son just got into Claremont McKenna, and he had an 8 a.m. appointment at the embassy to get a student visa.
Wow.
I mean, this stuff is like pretty intense. But a lot of these anecdotes that come from the Trump administrations, I'm like, well, is this a smokescreen because they're trying to pass the bill and they're trying to divert some attention over cause some fire over here so they can get things passed over here. But yeah, it's interesting. I'm with you. I think the idea is in. I understand the idea. The execution is a little peculiar. It's more like the sledgehammer to fix a bent nail kind of analogy. But we'll see. I also think that these things will pass over time. But can the reputation and perception stay intact? You mentioned this earlier. I've spoken to, and I'm sure you've had these conversations, like really smart people who, and at dinner, and the fact that do you think the rule of law will stand, or do you have ownership rights will stand? I'm like, of course they will, and we all know that the Constitution will stand. But the fact that really smart people are even mentioning this in a public forum, I find just incredible.
Yeah, absolutely. I have friends who hold U.S. passports but live in Singapore, wondering if it's safe to go back to their home country, which is ridiculous. Like the fact that they're even asking this question, is just very, very wrong.
Yeah. No, I hear you. Well, one of my passports is U.S., so we're going back this summer to go look at some schools. But, okay, so we've covered quite a bit. We'll open it up for questions shortly. I want to talk about, I don't know if you have a view on real estate. I have a view. I'd like to unpack a little bit about what I said. I do think U.S. residential real estate is a good investment at the moment. I think it's actually even better than it was previously because of a few things. One, there's a severe lack of supply, and that's factual, undeniable. Demand and gentrification is real. So the reshoring of manufacturing, way before Trump, even with Biden's administration and the CHIPS Act, they're building fabs, EV factories in the Southeast corridor. We have a couple in Singapore that in 4 years have purchased 22 homes in the Midwest. I promise I wouldn't say which state. In a Midwest state, and there was an Intel fab that was built 10 minutes away, and the homes have doubled. And these are small. These are $100,000, $150,000 homes. But this stuff is real. Now, here's in the U.S. has a culture of migration. I mean, one of the most famous U.S. brands is U-Haul. What is U-Haul? You pack up your things and you drive cross country to find a better life. But here's the kicker. I will contend that the American dream of owning a primary residence is gone. It's too expensive. And you'll see more of these anecdotes, but there will be no policymaker that will say this, because the average home price is $400,000 in the US, and the median income is $70,000, right? So a little bit less, say $62,000. So that's a 7 times difference between what you make gross and what a home is. And what that means is, especially with rates so high, that affordability is not there. And so you have to rent, right? Maslow's hierarchy of needs, you need a roof over your head, you need food to eat. So I think for people who can afford to buy homes to rent out, rental yields will continue to go up. And they're already low to mid-teens in many states. If you take out California and New York, you can find 12% rental yields easily. In Georgia, Texas, Florida, Ohio, Tennessee, and those states. So it's, and institutions know this, so to the extent that, people are selling, they're kind of motivated sellers, and there's always a bid there. So I don't think I can't see property prices coming off because there's a natural bid. Institutions like Blackstone are buying it. So buying a home to earn rental yield with a shortage of supply is squeezing up prices and yields. So it's kind of like the same argument for like gold and Bitcoin, but in a different way. So we're still really bullish right now. So awesome. We've got so I'm going to open up to anything else. I'm going to open this up to some Q&A. I do want to say for those out there that Geo's newsletter called Fidenza Macro is in the it's in the description below. Please click on his link. He's got a great newsletter. He actually talks about the trades that he's putting on himself. So that's what I find really useful. It's not just talk. And of course, if you want to contact me, my details are below. Let's open this up for some questions. Oh, my goodness. All right, these are all going to be answered by you. Uh-oh. What macro signals are you watching that could shift gold's current trend? Great question.
That could shift its current trend. So I guess he's asking what could send gold lower. Yeah, that's a good question. So one thing would be some kind of like fiscally conservative movement coming out of the U.S. Congress, where these fiscal conservatives stand the ground and be like, we got to get the budget deficit down. This bill is not going to pass. Get it down to like even sub 5% would be a big win right now. So that's one thing. There's been another more short-term development that's happened actually earlier this week, where the BOJ and the UK Central Treasury announced that they didn't announce, but they suggested that they might issue fewer bonds on the long end. So this is similar to what Janet Yellen did back in 2023, when she shifted borrowing from, reduced in the long end, or actually just like made it just less than expected, really, and then shifted a lot more borrowing to the shorter end. And this, generated a rally in the long bonds for a short while. So what this does is basically it kicks the can down the road. It doesn't mean that they're going to borrow less. It just means that they're going to change the composition of the borrowing. So because right now the fast money is pretty short, long bonds, so it could trigger a short squeeze in bonds, and gold could dip in sympathy. So that's just one thing that I'm looking out for. But I don't think that gold would dip, very much. I think because there's a natural inflow into gold with central banks buying. And you see like very aggressive rallies every time it sells off. So I think that would be more of just like a short-term correction.
Yeah. Okay. So let me kind of say what you just said in layman's terms. So basically, I totally agree, and I didn't look at it this way. So basically, what you're saying is, instead of terming out, the long end, they're refinancing at the short end, and that's actually making. So basically, gold is ticking a lot more boxes than it used to. So one of the boxes it's ticking is that the incremental buyer of bonds are not buying bonds, they're buying gold, right? But now if bonds become a little more attractive, I don't need to buy the gold. But that's just a short-term phenomenon.
Yeah.
Yeah. Okay. 5% GDP, the deficit percentage of GDP ain't gonna happen anytime soon.
Doesn't seem like it. Yeah.
All right, cool. Well, these are great questions. How should investors think about geopolitical risk, especially US-China tensions, in macro positioning? Gold, Bitcoin. I'll let you answer.
Yeah, I mean, right now gold is serving as a very good hedge on geopolitical risks. For example, when we saw Trump just last week talk about 50% tariffs on Europe, gold shot up. Gold was a huge beneficiary in April when Trump announced his Liberation Day tariffs. So that that's one of them. But overall, I would say, you have to be a lot more nimble in your investment strategy now. The days of buy and hold are no longer around. You have to really just, you know, take profits on the way up, always have some cash lying around, some, spare ammunition to buy dips, because those dips will come with all this geopolitical risk. But also, you have to start looking outside of the US. I think a lot of investors traditionally look only at the US because it's been the best market to invest in. But start looking at what's good outside of the US. And this is something that I myself have been working on and need to work on more, like looking at the macroeconomics of other countries that I've never even looked at before, like you know Argentina, Poland, Greece. I mean, those the indices of those countries have just outperformed by a mile this year.
Hmm, interesting. Yeah, it's so anecdote driven right now that and the price action, on a small anecdote could be hit your stop loss. It's like 5-10% moves in 1 or 2 days just on an anecdote. So you have to.
Yeah,
It's like it's almost like it's like trading altcoins. Like you got to make sure you have your stops in because you
yeah,
wake up and like there's some anecdote. Somebody got in a fight with somebody and tariffs are gonna go up to 200%, and then you're like, ah.
hmm
Um, um, oh, there's a Bobby Effendi who
hmm.
asked the question: what is your recommended portfolio asset allocation going into second half of 25, and where would U.S. real estate sit within the asset classes? Wow, I think that's part
Oh,
you and part me.
yeah, that's an interesting one. I don't know if I can recommend an allocation. Well, don't want to get too much into specifics, but
Yep.
obviously, we've been talking about gold. It should be one of them. During the 2002 to 2011 period, even though stocks bottomed out in 2002 and there was a bull market all the way until 2008, gold outperformed stocks during that period from 2002 to 2008 by a lot. I think over 50%. So there is a world which I think we're in, that where even though stocks go up, US stocks go up, gold outperforms even more. I also think that you should have some exposure to EM, Asian equities, LATAM, but really, it's hard for me to pinpoint or recommend any specific countries or weightings.
Mm.
Um, yeah, I mean, I'll let you talk about real estate, but real estate is another hard asset which
Mm.
should do well. I'm, personally increasing my exposure to real estate.
Mm.
So, yeah.
I do want to kind of do a quick interrupt this conversation. I should have said this early on. This is a conversation is not investment advice. This is purely for informational, educational, and entertainment purposes. So hopefully all of this stuff is informational, entertaining, and you find it, educational. This is obviously, just two dudes chatting about markets. But you should always speak to your financial advisor. I just want to get that out of the way. Um, Okay, cool. How should investors think? Okay, we already asked that one. Okay. So, what I find interesting is a lot of these questions are the interrelationships between gold, dollar, crypto, which are all kind of the same thing, but it's all this that people have uncertainty about how these interplay with each other, and I think
Hmm.
this is why I think having you on has been really great. How do you see the relationship between gold and crypto evolving, and are competing hedges or serving specific investor needs?
I mean, gold is like is the lindiest of all assets. It's been around for millenniums. I think Bitcoin is still going to be tied a lot to risk on, risk off. So, you know, I think the downside volatility of Bitcoin is still there. Like, it's not going to be, um, if equities sell off, like I do think that Bitcoin could be vulnerable. Um, but yeah, so how do they correlate? How do they interact? Um, I think, they're not going to be going up and down like one for one at the same time. And I don't think that's going to happen anytime soon. I mean, I could be wrong, but I don't see them as interchangeable. I have my view on Bitcoin based on one set of global macro fundamentals, and I have my view on gold based on another set of global macro fundamentals. So hopefully that answers the question.
Okay. I think this one's for me. How do you see U.S. real estate performing in a scenario where dollar weakens further? Is that good or bad for international buyers? That's a really good question. So, I think there's two ways to look at this, right? So, dollar strength is good if you already own the property, because that means the property goes up in value, you do the exchange, and then you bring it back home, and you have more money. Dollar weakness means that things are actually cheaper for you to buy. Now, the question is, when you're earning your positive rental income, obviously that currency that currency is now weak versus your currency. But it also depends on where you're buying from, right? If you're buying from Europe or other G20 countries, it could be different. But if you're buying from maybe Southeast Asia, where the currency are a little more volatile, the dollar may not weaken. It still may strengthen. Places like Malaysia, I'm just naming a few. I don't know how the currency has been trading, but it really depends on which country. But I think the dollar weakness is, you shouldn't be buying U.S. real estate if you're just focused on dollar exposure. You should just buy dollar exposure. But if you're looking to buy a hard asset with proven upside over the long term, with fundamental supply and demand landscape that's in your favor, I think it's a good bet. Next question: Do you see investor crowding in AI or tech names as a signal of strength or fragility? Interesting question. I've got a take on this. I want to get your take.
Yeah, investor crowding. I mean, I think that crowding has gotten a lot better. I mean, the crowding has decreased a lot ever since April, and this is reflective of the entire market, not just AI and tech. So a lot of the froth has come out in terms of investor positioning and exposure, but what hasn't come out is really like the PE valuations. With the S&P, I think at like 20x or something, it's still pretty rich and doesn't leave a lot of room for any downside economic shocks or shocks to earnings.
PE, I mean, you sound like a value investor, not a macro investor. So my view is, I look at it like, listen, you've got debasement 8% a year for, I don't know, last how many years, plus now you've got inflation, well, let's just say 5%, 3 to 5%. If you're not making 15% return, you're actually kind of losing money. And, tech offers this type of return. But also, I think institutions know this. Institutions globally know this. And that's why they've all parked into the Mag 7. And now all Mag 7 or Mag 8. Mag 7? All the
It's always
mags.
changing.
And all of the mags now have an AI aspect to it. And I will say, I did an interview on AI recently, and I will say, however you think AI is going to change your lives, I think you've underappreciated the impact that it will have. So I think it's really exciting place to be if you can find investment exposure. Right now, there's just not enough ways to put your money into AI. It's basically, Meta, Google, NVIDIA, basically all the Mag 7s plus NVIDIA. All right, we've got Leonard Lim. Where would GMG see as the top 1 to 2 U.S. real estate places to put money into? Number 2, U.S. real estate versus other countries like UK, Singapore. How attractive is it? Cheers, Leonard. Okay, I can answer this. So in the U.S., listen, like places like California, New York are very different. New York's a very store of value place. It's a pied-à-terre place. So people, the high net worth community who like to collect these toys, place in Saint-Tropez and Monaco and New York and Paris and Miami, that offers that. Rental yields aren't great in New York, but it's a great store of value. And the price appreciation is very stable. In California, listen, it's great. Irvine, heck, Irvine property prices have gone up 10 to 20% every year the last 5 years. But I would say if you're taking emotions out of it and just looking for price, a good rental yielding price appreciation, places like Texas, Ohio, Tennessee, Georgia, I really like. There's a lot of, there's 9 EV factories being built as we speak in the Southeast corridor. Each one of them hires 2,000 to 5,000 people. These folks aren't going to be able to buy; they have to rent, right? So this is the kind of stuff that I like to look at. Atlanta's great. It's plug and play. It's the busiest airport in the world. USA football is going to be moving there. It's Hollywood 2.0. A lot of movie production is there. So I like those themes. I just don't have the time to buy a place and maybe fix it up and overlook it. But some people who have the time and that want to do that can. Just U.S. versus other countries. So I will say that historically, when you buy real estate, especially in Asia, it's just what people are comfortable with. There's a lot of people that they're not buying Nvidia or Apple. They know real estate, especially the older demographic, and it's always been easier to buy where you live. The market. You have bank financing. You can drive to the place, but it's always been buy and hope the price goes up. Like in Singapore, you can't make money off. It's a negative rental yield market. Very rarely can you get positive carry, and that's worked though because interest rates have been very low, and you've made money on property, and people think I'm really good at property investing. But the new paradigm is you have to get cash flow, right? And I think the U.S. is definitely the highest rental yield market in any G20 country. I think Dubai is really hot right now, and people people are buying and selling before completion. That's kind of bubbly. To me, Dubai doesn't have a real. It's like Monaco. It's rich people moving there to to do whatever, and I think it can go on for a while, but I don't know. It's not it's not like a G20 country.
It's hot money.
It's hot money, right? So you can make money, and a lot of people are. It reminds me a little bit, and people in Dubai are going to hate me for saying this, but in Asia, remember when everybody was buying Vietnamese property, right? It's like you were buying them, and things were doubling in 2 years, but I don't know anything about it, but it's a way to make money. I hope that answers your question, Leonard. Well, this is, I think I've answered all the questions on my Zoom Q&A. Richard Kleinsmith, I'm watching from the Middle East. I'm wondering what Geo is monitoring from the region, perhaps oil price? All right, so it turns out there are a lot more questions.
Oh, wow.
So actually not a lot more. Okay, look, we're going to end with one last question, and then I promise everybody that we're going to answer these individually by email, so no question will be left unanswered. Hi, Donald. I wondered if there was a way to inform myself on which areas in the U.S. would have the potential of great capital appreciation, not just an increase due to inflation. I think we're all looking for the same outcome. And as a couple, you mentioned that purchase in the Midwest. Yeah, actually, this is a really there's no way for me to answer this. We've actually done all kinds of work on demographic shifts. I'll just say one thing. When people, put yourself into the shoes of somebody, say in California, you get a job at Tesla, and Tesla's a big company, and you're making, I don't know, $100,000 a year. It's great, but it's too expensive to live in California. So what do? You want to move someplace. So you want to move someplace that has good schools, low crime rate, low cost of living, maybe no state taxes, hint, Texas. And these are all, so you have to kind of preempt what an American family would look at. Job opportunities, where can they move to, things like that. Landlord-friendly states, places with low crime. So we have all that information. Please email me and we can talk about this. It's a little long for me to answer on this show, but the key to that question is put yourself into the family of, like all of us. Like if you wanted to move someplace, we want to be near shopping malls, near good schools, low crime rate, things like that. I'm going to wind up this first episode of Macro Matters with Geo. Really thank you for your time. It was super insightful. I hope everybody in the audience had a good time. We do want to shout out to Paddle Locos. Hi, Paddle Locos.
Paddle Locos.
All right, thank you.